This video is exactly like a miniskirt, short enough to attract your attention, but long enough to cover the essentials. Blue Bull Forex is my name, and welcome to the Insight Empire. This is where we give you insights to do with the trading Forex market. And today, we're going to be talking about one of the most important concepts of trading, the concept of liquidity. Basically, Forex market moves because of three technical reasons. The first technical reasons why any Forex market moves is basically to hunt liquidity. The second reason why the Forex market moves is to rebalance imbalances. And the third reason why any Forex market moves is always to retrace to at least the equilibrium point of any Forex range. And this is exactly what I'm going to be explaining in the next subsequent concept. But for today, let's just stick to the agenda of the day, that what is liquidity. And today, we're going to be talking about two types of liquidities, which is basically very, very important. Remember, anytime you are trading and you cannot see the liquidity, you are basically the liquidity. Now, let's dive into it. We are basically talking about points where most of the people who are participating in this particular market are likely to have placed their sell stops, buy stops, stop losses, and all that, or zones basically where the smart money would likely to be interested in. And basically we have two types of liquidities that I'm going to highlight in this particular video. We have the external range liquidity, known as the ERL, and the internal range liquidity, which is known as the IRL. All right, basic concepts, but very, very technical in Forex market. Now, when you talk about external range liquidity, this is basically the liquidity that lies below or above a series of either odd highs or odd lows, or a series of equal highs and equal lows. And that is exactly what I'm going to demonstrate here. Now, basically, we have three kinds of Forex market. We have a market which is moving upwards, a market which is coming downwards, or a market which is basically ranging within a specific point or a specific pattern. All right, now a market which is ranging is called a consolidating market. A market which is moving up in a clearly defined uptrend is called a bullish market, and a bearish market is the exact opposite of a bullish market. This means it's a market that is creating a series of lower lows and lower highs as it breaks its structures to the downside. Now, this is it, pretty much easy. When you have a series of a range market which is ranging, there are always people who are basically trading support and resistance, one of the strategies that I don't advocate for. All right, most of them, they are putting their buy stops and sell stops at these particular zones. So this means these particular points are points of interest for the smart money. Why? Because they know when they are selling here, at this particular point is where they are likely putting their stop losses. All right, this is where they are putting their stop loss. Let me make this different. So this is stop loss zones. So those are stop loss for sellers who are basically trading this market, and buyers are putting their stop loss down over here. All right, buyers are putting their stop losses down over here. So the smart money are in constant, because you have said the first technical reasons why this market is moving is to try to hunt liquidity. Hunting liquidity is they are looking for ways to take out this money, because basically liquidity is money. All right, so they will try to take out these liquidities before they go back to the direction of the trend. All right, and this happens also to the sellers. They will try to extend that way. You will hear most of the price action traders talk about fake outs, breakouts, and stuff. So a fake out is when the market completely takes the liquidity and continues to the direction where it has taken the liquidity, or basically it takes and then it reverses to the opposing direction. And remember, anytime the market shifts liquidity, basically it's supposed to go to the direction opposing the direction of the sweep. So for example, if it sweeps this particular sell side liquidity, it will go to the opposing direction for buy side liquidity and be able also to take out those particular liquidities lying either above or below. Now, this liquidity which lies above this particular series of equal highs is basically what we call external range liquidity. External range liquidity. This is external range liquidity, and the one also that lies below here is also external range liquidity. All right, so basically external range liquidity is the liquidity that lies above or below a series of either equal highs or equal lows, or a series of higher what we call the old highs and the old lows, as the 7 institutional reference points was defined by the ICT. Now, internal range liquidity is the exact opposite of this. Most of the time we'll find internal range liquidity in a market which is in a clearly defined trend, and mostly internal range liquidity comes either as a result of or in form of 1, liquidity void, 2, a fair value gap, or an order block. So within those particular zones is where most of the times we will be looking for internal range liquidity. If you have not watched my content on which one are order blocks and fair value gaps and liquidity voids, there is a video that I've already done explaining all those particular stuff. I just want you to navigate across all my videos in the playlist and be able to take advantage of that particular insight. Now, here we are. A market which is moving upwards in this particular manner. All right. Your responsibility is to enter at the end of the pullback. That is how we make money. Actually, people still lose money. Despite that, it's very easy to know whether the market is going up or going down. You can buy in a market which is going up and still blow. You can buy in a bullish market and still blow. You can sell in a bearish market and still blow the account. Now, this is why. If you enter at the pullbacks, because the market goes by creating pullbacks, which in smart money we call retracements. So if you trade for your buy position here, the market will have a pullback to take you out, then it continues to the direction. And most of the problem with especially the retail traders is that they do what the market is doing. Now listen, when you do what the market seems to be doing, most of the times you'll be sexually violated, which is not a very bad thing in case you are willing to, let it just do so. But now listen, if you buy in a market which is continuously buying, you are going to be duped up. Why? Because the market does not do exactly what it looks like it's doing. All right? And that is why most of the beginners will argue, when I buy, the market sells, and when I sell, the market buys. So the market is designed to do exactly the opposite of how beginners reason. Because some beginners will look at the market, see it has formed a green candle, it's going up, they click buy. From the exact point they have clicked the buy, the market then retraces and decides to sell. It's a very bad thing. So what do you want to do? You want to look for the market at a point where it's going to reverse to the opposing direction. For example, this is, assuming now you are trading based on this particular channel, you don't want to enter buys here, although the market is buying, because if you buy here, long position at this particular point, and then that's where your stop loss is. Your stop loss will be taken, and after hitting your stop loss, the market will still go your direction. Then you will wonder, is the broker watching me, seeing where I put my stop loss? Because they always reverse exactly at your stop loss. Now, let me explain why. But someone else will enter at this particular point for a long position. Then they are going to target the previous high, which is basically this particular zone. And these people will not be stopped out, and they are going to harness or take advantage of this particular movement. So for you, you were disadvantaged. You were a collateral to this particular pullback, something that you could have just waited for it to end before you can join the market. Remember guys, it's 90% waiting and 10% executions. The problem is most of the retail traders do the opposite. They execute 90% and they wait the 10%. And that is the only thing that clears a distinction between the profitable trader and the otherwise. Now, this is it. People who are buying at these particular points, they are putting their stop losses down over here. So they are buying up, buying here, buying here again. This is where their stop losses are. All right. So these particular zones are stop loss zones. This is where they are putting their stop losses. So there is a lot of money to be swept by this market, and that is why most of the times the market will always revisit these particular zones. And if you understand the market maker buy model, it looks exactly something of this particular caliber. All right, it looks exactly this kind of a thing. exactly this kind of a thing. All right. Exactly this kind of a thing to the upside. Why? Because the market goes up and then it will try to counter all these liquidities to take advantage of them. The people did not close their entries and stuff. So this liquidity that is found in between this particular market movement or between the pullbacks is basically the liquidity that we call internal range liquidity. Liquidities, internal range liquidity. Ladies and gentlemen, that is how simple it is, and we're gonna be doing this kind of a content. Please, in case you find this particular content very educative, please be sure to like and subscribe and also share to your friends, because that is the only way you can be able to motivate us to do more and more of this particular content. And we're gonna be doing this more and more in the next subsequent videos. In the meantime, it's a goodbye from all of us.